What's going on, guys? This is part one of our Intro to Trading Options series, and let's get right into it. So, a lot of you guys know my primary focus when it comes to trading is on the options and has been on the options side for a good amount of time now. For those of you who are kind of new to focus trades or new to following me, I've been trading since the age of 14. I just turned 25 in October, so 10 to 11 years, and I started learning from my dad when I was 14, and my pops is a professional wealth manager. He has a office here on our property and has, made a great living in the markets his entire life, and, I couldn't have been any more blessed to have had a mentor in this game as a parent. But the reason I bring that up is because, over the course of, my 10 years, and mind you, I was 14, so I wasn't trading every single day, all day. I still had the, school, sports, grabbing titties, all that stuff. So for the past 3 years or so, 3.5 years, I've been doing nothing but trading in terms of, supporting myself and making an income. And, as of, call it the last year plus, my focus has been 100% on options. And I don't even remember the last stock or the last trade that I took where, I didn't buy the options versus the regular stock. Now, I do like to put money into stocks that pay me dividends. Of course, I buy the common shares in those situations. But enough rambling. Let's get into options. Now, one thing I want to say, guys, is that on the surface, options seem, incredibly complicated. But, rest assured that once you just kind of get a proper understanding of, the function and get some of the terms under your belt, it makes a hell of a lot more sense. So tonight, that's what we're going to do, is just focus on, giving you a basic understanding of what options are, the lingo. We'll run through an options chain, and that'll be it for part one, just to give you guys a good understanding. So, intro to options, part one. Now, the first obvious question is, what an option? And what I tell everybody, when I get messages on Instagram or whatever it may be, an option is just simply a leveraged way of trading a stock. For less money, you're controlling, a lot more of the stock. That's kind of the way that I look at it, and oftentimes, an example, if you buy an option call, it's almost the same as if, you were owning, 100 shares, 100 shares of the actual stock for each options contract. So don't get, discouraged by all these terms. Just understand that you could either buy Apple stock, and if the stock moves up 1%, you make that 1% profit, or you could buy, at the same time, you could buy options on Apple, and because options are a derivative, which means that their value is directly tied to, the value of the stock. So options on Apple will go up if Apple stock goes up. If Apple stock isn't going up, then your options aren't growing in value. So it's always tied to the actual stock itself. And from, a charting perspective, finding the setups, entries, exits, profit taking, everything is basically exactly the same, except, when you're placing your order, you're just buying options contracts instead of the shares. So, there's not really a specific strategy for me personally, when I'm trading regular stock versus buying options. It's the same process. It's just that when I go pull the trigger, I'm buying a much more leveraged asset. So, like I was saying, you could have, a position in Apple stock. The stock goes up 1%. You make a 1% return. When on that very same day, on that same, 1% move for the underlying stock, many options will go up 10, 20, 50 to 100%. What I found, typically buying, at the money options, it's it's crazy. I don't have an exact number of, what the risk reward ratio is or the comparison, but just know that it is tied, the performance of your options contract is directly tied to how that stock is doing. So if you buy calls on Apple, you are not going to make any money unless Apple stock itself trades higher. So again, plain English, trading options just simply allows you to, first of all, 100% guarantee your max risk while opening you, to potentially much larger returns. The great thing about options, guys, if I put, say $500 into options calls on Apple, and the next morning Apple just gets destroyed, crap news out of the company, whatever, the stock could drop by 50%, all I'm going to lose is that $500. My account can't go down anymore. It's just that simple. So that's the beauty of options. You have a situation where you can say, hey, if shit hits the fan, this is 100% guaranteed, no questions asked, how much I would lose. And keep in mind, guys, if you risk $500 on an options trade, you probably likely will never, and with proper risk management, don't have to actually take that $500 loss. You could lose $100. It's the same as owning a position in the stock. You get to decide when you pull the trigger, entry, and exit. So again, options just allows you to 100% guarantee your risk, while also opening that window of opportunity for some pretty crazy returns. And I think that one thing that can be very discouraging about options is that all of a sudden you've been focusing on trading stocks for a few years, you're getting comfortable, you're getting familiar, and then this whole options thing comes up, and now there's all these terms, all kinds of stuff you never heard before. So let's get a few of these basic terms out of the way, and that'll probably help a lot of you guys who are new to trading options or just new to trading in general feel a little bit more comfortable. So the first term we'll talk about is a call. I'm sure you've heard options calls. You guys see my trade alerts. I'll say, I bought calls on, etc. When you buy a call, that is the same thing as going long the stock. So if I think that Apple stock over the next 2 weeks is going to trade higher, I will then go buy an option call. Now that call will make money because options, again, are tied to the stock. It will make money if the stock price moves higher. If the stock price moves lower, then my options calls lose value, putting me at a loss. Now, on the flip side, if I thought that Apple was going to fall over the next 2 weeks or however long, I could go buy an option put. So let's be clear about that. If you want to go long a stock, but you want the leverage of options, you buy an option call. If you want to go short a stock with the option leverage, you buy a put. Now, a put increases in value if the underlying asset decreases in value. So I can buy a put for $1. I buy puts on Apple. I pay, $1 for the put. If Apple stock falls, that put is going to move up in value, $1.10, $1.50. So very simple, guys. You think a stock is going up, you buy option calls. You think a stock is going down, you buy option puts. Very simple. Now, the next thing you're going to hear is expiration date. So for you guys who are in focus trades, you'll hear me say, all right, trade alert, I just bought the Apple December 22nd, 140 calls. What does all that shit mean? When I say, I bought the, December 15th or the December 22nd or whatever date, anytime there's a date, with options, that's just simply the expiration date. And what that means, in plain English is the date the option expires. And go figure, right? Very simple, guys. An option is a contract that has a date that it expires. So, using our example of Apple, I buy the December 15th Apple calls. Come December 15th, those options, that contract is going to expire. It's done. You either made money or lost money, and then you move on to, the next round. And I'll show you guys that on the options chain. And one thing you'll hear me say is strike. And, you can get pretty deep into this term. For me and for you guys, simply put, strike just tells you when the options themselves would be considered in the money, out of the money, or at the money. So we got that out of the way, guys. Now let me just flip over to my options chain and we'll kind of see what those terms actually look like on the chain itself. Alright guys, now this is where most, new traders and traders who are new to options, this is typically when they have a stroke. So this is called an options chain, guys, and this is my my thinkorswim platform from TD Ameritrade. I highly recommend it, and I highly wish that TD Ameritrade would give me commissions on all the suggestions I give. So guys, this is an options chain, And let me actually put in Apple. You can't see it right now, but here we go. So this mess right here, guys, is the options chain for Apple stock. So we're going to work, we'll work through this right here very slowly. So you guys up here, you'll see the different dates. December 8th, December 15th, 22nd, and so on and so on. That date is the expiration date. So what we're going to do is just focus on, one set of options. So here we go, guys. These are the options, the Apple options that expire on December 22nd. Right here, guys, on the left side, we have our calls. So these are all the option calls over here, the individual contracts, and to the right side are the puts. So again, I think Apple's going to go up in the next 2 weeks. I go to my options chain, I type in Apple, and I'm going to come down to, the December 22nd options because they expire, as you can see, in 8 days. So for you new options traders, you might want to make a note of this. You might find, over time, your own personality, your own goals, etc. Me personally, I typically like to buy options that expire anywhere from 15 to 30 days away. That gives the stock enough time to make the move that I'm expecting without too much crazy volatility. So if I were to be buying Apple today, Apple calls, I would have gone to December 22nd, 18 days away. So that's the first kind of confusing thing we can get out of the way there. What do these dates mean? Just simply the expiration date, guys. You have a list of contracts in here. They're all going to expire on the 22nd of December. Now, in this example, I said I want to go long Apple. So, as we mentioned before, I would be buying calls on Apple. So, let's take a look at the calls now. So, I want to buy calls because I think the stock is going to go up. If the stock goes up, the calls go up in value. So, guys, look at all the different options we have here. This looks very confusing, but if you just go step by step, it all becomes a lot clearer. So, the first thing is the expiration date. Okay, this expires in 18 days. That's enough time for me. I like that. Now what you have over here, guys, in this column, and let me pull that little bitch down. This is your strike column. So this basically is just your indicator of are the options in the money, at the money, or out of the money. What does that mean really? So right now, as you can see, Apple stock itself is trading at $170. So that is the value of the underlying asset of these options. Apple is the underlying asset. It is trading at, call it, $170. We're off by 20 cents, but Apple's trading at 170. So what that means is that any of these options with a strike under 170 are considered in the money options. Of course, the 170 contract, 170 strike price, is at the money. Apple's trading at 170. The strike, these option calls are at the money as well. And then something you guys should probably rarely ever buy is the out of the money options. Again, you could go buy 180 strike calls on Apple, but the stock is only at 170. So if the stock were to pull back to 165, that means that these 180s are even further out of the money and they get destroyed in value. So, how does this all tie in? Where's the sweet spot? My suggestion to you guys, and a suggestion of, most who have traded options for a while, is to always buy either at the money, so in this situation would be the 170 calls, or somewhere slightly in the money. Now, what is the benefit and the risk to each? I'll tell you right now that, nothing is better, nothing works better when it works than buying the at the money options. So let's pretend it's 9 o'clock in the morning. Let's pretend it's 10 o'clock in the morning. Market's been open for a half hour. Apple's looking good. Trading at 170, and I go buy the 170 calls. And a few minutes later, Apple's creeping up. 172, 175. Because those options, those calls with the 170 strike at the money, they're going to increase in value, very quickly, as opposed to the ones that are now becoming, more so in the money. And we're going to discuss, in the money, out of the money in more detail in part 2. But this, guys, hopefully made this big mess seem, a lot simpler. So let's just do another example. Actually, let me see. Let me think of a current example from today. Boom. Starbucks. Now, this morning, Starbucks was trading at where are they? Okay, so Starbucks was a signal for me this morning. The stock was around $58 at the time. So here was the process, guys. Starbucks stock was in a nice setup, which I wanted to invest in. But because I want the leverage of options, what did I do? I went to my options chain, which will be different for every broker. I typed in Starbucks, and now here's the entire options chain for Starbucks. What's the first term we learned today? Expiration date. I want to give Starbucks stock enough time to make the move that I expect. So 15 to 30 days till expiration is good enough for me. December 22nd expires in 18 days. We're going to take those. Okay, that's step 1. The second term that we figured out is, calls and puts. Because I think Starbucks is going to go higher, I'm going to be buying over here on the call side. So expires on the 22nd. It's enough days for me. I'm going along the stock, so I want the options calls. And again, the stock was around $58 this morning when I took the trade. I felt confident it was going to continue to move, so I bought the right at the money options, which are the 58 strike calls. And that turned out to be a good trade, guys. I only put in about $500 or so, and this is just kind of a good example of how options work. I put in about $500. The stock maybe went up, 0.5%, a little bit more, from my entry. And I made about a 50% return on those options. So again, stock goes up 0.5%, but because I bought the at the money options calls throughout the course of the day, those calls were up 50% plus. So again, guys, I hope that this kind of makes this all a little bit more clear for you. I'm sure it's still a little bit intimidating on the surface, but if you if you understand what a call is, what a put is, what an expiration date is, and what a strike price is, you basically have, the foundation for understanding options. And that gives us, the opportunity in the next few videos to kind of build upon that. But here are the things to remember, guys. Options are just simply a leverage way of trading a stock. Options are tied to that underlying stock. So if you have calls on Apple, those calls will increase in price if Apple stock goes up. If you have puts on Apple, which are a bearish play, if Apple stock falls, those puts go up in value. And that's how you make money, guys, with options on the most basic level, and it's the only level that I really use. So in tomorrow night's video, we'll kind of break a little bit deeper into this, certain strategies, how to calculate position sizes, because that's something that's very important. You're going to see over here, the bid and the ask. It looks like, the 58 strike calls are going, for 130 to 150. It's confusing. I don't know why they do this in options, but if you were to buy this right here, buy the 58 call for $1.52, it's really worth $152. So whatever the price is, guys, always multiply by 100 to figure out, how much you would actually be investing. So, $152, $227, etc., etc. So we will build on this tomorrow night, but I hope this at least made this all a little bit simpler and kind of puts you guys at ease. Take your notes. Just, continue to go over these terms tomorrow. During live market action, don't jump into an options trade. Don't rush. But if you see a stock you like tomorrow, guys, by all means, pull up the options chain, if you can find that on your broker, and and go through the options chain. Maybe run through the same exercise that we just did. Okay, let me find the ones that expire X amount of time. I want to buy the at the money, in the money, etc. How much would it actually cost me for one call? And again, guys, just going over these terms, working through it in your head, and just getting a solid, grasp of what the hell this stuff even is, makes it seem a lot simpler. And you should be very excited, because even with a small account, options is just a huge world where there are thousands and thousands and fucking thousands of % of gains to be made. So be motivated, be calm with options. I hope this helped, guys, and we'll jump into it tomorrow night in part 2. Peace.